Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 428. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the oldest podcast on the internet about insurance.
And insurance accessories.
Yes. All the things. All the
Yeah.
things. We think it's the best. Some people might argue. But
Again,
that's our opinion and we're sticking to it.
as I've said before, we're just the only ones that were dumb enough to keep doing it. So
That.
many others have come and gone.
Mm-hmm.
We're still here.
Off to
Coming
better
up-
things. We just
Coming up
continue
on
to do this.
13 years, by the way.
13 years. That's,
September, I think, will be 13 years.
yeah. It's a long time
That's a
to do
long
podcasting.
time.
It's a long time to deal with me, so congratulations to you.
Likewise. I think people think we talk all the time. Actually, it's just once a week.
The truth is, it's one of those Hollywood relationships. We sound amicable
exactly.
on the podcast. We
That's
hate
right.
each other in real life.
We've got like a 1,200 mile buffer. So that helps.
It's the secret behind our success. So, whole life insurance is a great way to protect your wealth.
Yep.
That's what we say, and that's what we're going to talk about today.
All right. Well, it's good hearing from you. Hope you guys enjoyed. This is all new stuff. All new.
It's a podcast about life insurance. There's never anything new.
That's right.
Well, on occasion, maybe there's some crazy story. We get really excited about those days. No, this is a good subject because this highlights an element of life insurance that I think is fundamental to what we set out to discuss with the Insurance Pro Blog.
Yep.
Well, at least what I set out to discuss because
Mhm.
I was here for about a 6-month period before you were. But anyway, the idea behind whole life insurance, really any cash value life insurance, is, I think, very different with respect to how people actually use it
Mhm.
versus what a lot of people assume it's for.
Mm.
Because there's so much discussion, so much time wasted on the discussion about what it costs to buy a unit of death benefit for whole life insurance, for
Yeah.
example, versus what you would pay if you just bought term insurance.
Right.
And look, nobody here has ever wanted to make the argument that somehow, magically, through whatever sort of financial manipulate or mathematical manipulation we want to do, whole life insurance is going to become less expensive.
Right.
If we're talking about the dollar you got to take out of your pocket today to buy life insurance, term insurance wins. There's no doubt about that.
Right. Right.
But there are things whole life insurance can do that term insurance simply cannot do.
Mm-hmm.
And that, my friend, is why you might want to actually buy it.
Yeah. I don't know. Comparing whole life insurance and term insurance on cost structure is, to me, that makes about as much sense as comparing. I'm trying to think of something super expensive. A Rolls-Royce.
Mhm.
You know, like if someone says, "I just need a car to get me back and forth from work."
Yeah.
Let me tell you about this $350,000 Rolls-Royce. Like, a Honda will do. I mean, it just doesn't. Are they the same? Well, they're both cars.
They both
But-
have 4 wheels.
That's where it stops. It's not that one is better or worse than the other. They both will do the job, but they are built for different things.
Mm-hmm.
And that's always the problem I have when people will say, whole life is just too expensive.
Yeah.
And I'm like, well, to steal a line from one of our friends from years back, compared to what?
Yep.
Like, and you have to look at it on a net cost basis
This is true.
over time, not, well, yeah, if you're looking at it first year, probably not the best thing ever. But you have to look at what's the net cost of owning it over time. And
I would argue on top of that, all of the other things it would bring to the table. Now, that's not necessarily, from my perspective here, to argue that you need to buy whole life insurance because there's other stuff you might use someday.
Right.
What I'm saying is don't be myopic and discount whole life insurance and what it brings to the table because you read half of an article that said, no, you should just buy term insurance.
Right.
That's where I think the problem comes. And I can speak from experience in saying, having had the conversation with a number of people now who spent a little bit of time listening to the Insurance Pro Blog podcast, reading the Insurance Pro Blog, whatever it is that they did to get to the point that they've decided, maybe I do want to think about this. And then coming to us and saying, for years I thought, nope, don't want to do that because I had been told don't do that. And then I realized, no, I might actually have some circumstances going on that would warrant purchasing whole life insurance. And I wish I had thought about that 5 years ago.
Right.
So we can always go down the list. It's got very tax preferred treatment in terms of tax deferred growth and tax free distributions when it's done correctly. It's got guaranteed accumulation. It's got some really fantastic wealth transfer aspects to it when it comes to either protecting your legacy or your assets from transfer tax issues if you're wealthy enough to have that issue, or just simply the efficiency with which death benefit transfers to the next generation or whatever it is that you're trying to send money to versus money sitting in the bank.
Right.
Those are all things that life insurance works really, really well for as a tool. And that's the core of what we want to come here and talk about today. We have always argued that it is a far, far better wealth preserver than wealth grower.
Yeah. Are you changing your opinion?
No, I don't think so.
Oh, okay. The way you said it made it sound like we've always said that, but like there was a but coming.
Oh. No, I'm just weird in terms of English and communication. That's something I do.
King of the passive voice.
Hey, somebody's got to do it well. Or at least do it. Wells, I guess that's a little subjective. So when it comes to various things people, at least in our experience, worry about, and this is coming from the perspective of, yes, the bias of the fact that we are this blinking light on the hill saying, hey, life insurance people, come talk to us because we're friendly. But beyond that, we've both existed in the investment and financial advice world for a long time as well.
Mm-hmm.
We've had many conversations with people about their personal financial objectives, and never did we talk about life insurance with them.
Right.
So we've got a pretty good perspective here.
Mm-hmm.
And when it comes to wealth, and I don't mean wealthy Rockefeller type situation, I just mean wealth in the sense of, hey, I'm however many years old, I've been working for a number of decades, I've accumulated some sum of money, it is the totality of my wealth. I would like to protect it. I would like to preserve it, and I would like to pass it on to the people that are meaningful to me.
Right.
We see a pretty consistent pattern of things those people talk about.
Mm-hmm.
So these are things like, one, once I have the money, I don't want to lose it.
Right.
And we have certainly, in a number of situations, shown people how to take serious gains from some great investment, inheritance, whatever the situation is. Maybe it's just slow accumulation of assets, and de-risk at least some of that exposure by buying life insurance.
Right.
So you take a piece of it and you move it into life insurance because the cash value will accumulate and it'll enjoy several great tax features.
Right.
There will be no taxable implication to the gains on the cash year over year. And you can also distribute it without any income tax liability. There's a specific way you have to go about doing it, but it's not that complicated to do.
Yep.
So that is a way to take the wealth you have accumulated up to this point
mm-hmm.
and set at least some of it aside.
Yep.
And ensure that it's not going anywhere.
Mm-hmm.
That it's not going to be taken down by changes in tax law. That it's going to be taken down by a market correction or a bad
mm-hmm.
economic situation.
Mm-hmm.
You have that to rely on. And you and I were actually just discussing this before we started recording, that in the world of investment planning, there's a lot said and a lot done in the spirit of downside protection.
Right.
But one of the things that oftentimes goes overlooked, under discussed, is the fact that diversification is mostly the enemy of growth.
Right.
So, okay, yep, we've been able to preserve, at least to some degree, the ability to keep the money in a bad market. But when the good market comes, we don't really do that well.
Right.
Life insurance, be it whole life insurance or index universal life insurance, is rock solidly guaranteed from the downside.
Right.
But accumulates consistently.
Yeah. No big fluctuations.
So it has a great way to protect you from bad times while also consistently growing. Unlike some of the other assets that are out there that can fluctuate, they can grow, they can fall in value though too. They just don't fall as badly as, let's say, your exposure to the S&P 500.
Right. Well, we've always talked about the true diversification in your financial portfolio. And I'm throwing everything in there.
Yep.
Is not reduced correlation to particular assets. It's no correlation. It's having different pieces of the pie that just have nothing to do with one another. And we consider life insurance to be one of those.
Yes.
I mean, I think about some of the best use cases we've seen is it's not even about people accumulating directly through paying life insurance premiums, though that is obviously a functional piece of this because that always happens. You got to pay premiums. But it's a risk transfer proposition. Yes. And it's not going to be what people are thinking. But we've had people who are in careers where they have either a career or a business that they own where the income can wildly fluctuate from year to year. And so in the years where they have, I'll just keep it simple and say they have an outsized net profit that they wouldn't normally have.
Okay.
That they don't need to sustain themselves on a day-to-day basis. They take that money off the table and they dump it in life insurance.
Yeah.
We've had quite a few people do that.
Yep.
And that's either, and in that scenario, it's, well, I have enough exposure to this, like people who own a business will understand this, but a lot of times people will say, well, you should just put that money back into the company. Well, it's not always the right answer.
Correct. There
maybe
may
they feel
be,
like they've already put enough.
Yeah. Or they may just not see much of a growth opportunity.
There you go. I was going to say, or they see that they're going to have a very low return on that, because they're in an industry where things just don't move that quickly. So take the money off the table, move it here somewhere safe where there's not a lot of risk involved, and keep on going down the road.
And speaking of diversification, if you constantly reinvest in the business, you're going to significantly up the ante of a very singularly exposed, extraordinarily risky circumstance where everything is tied to the success or failure of the business.
Right. Exactly. Which, when a business is new, I completely understand.
Yes.
There's capital needs. Absolutely. But I'm talking about, we're talking specifically about people who are well established, consistently generate a net profit.
And no one's saying you can't one day take the money back from the life insurance policy and use it for the business.
Sure. Absolutely.
I believe there's a group of people out there, they have an entire concept about that, something about banking and infinity and stuff.
Buzz Lightyear, Infinity Mail. No, I'm kidding. Yes, exactly. That's more along the lines of what we talked about last week.
It is exactly, yes. Yes, it is. But it works. It totally works. But it gives you also a cash position that you can leverage.
Yep.
In a way that is not easy to obtain in other financial instruments. Not impossible, but not easy.
Mm-hmm.
So the idea that you can grow cash or value in life insurance consistently, guaranteed, and have no exposure to downside because it will not go backwards.
Right.
It simply won't. If the market crashes, if your business crashes, if some weird regional thing crashes, life insurance stays put.
Mm-hmm.
And the capitalization of life insurance companies as an institution is substantial.
Yeah.
And very, very, very protected from a number of really ugly things that can unfold.
Right.
In an economic system. They just are. It's weathered a whole lot of storms and done so very, very resiliently.
I feel like there's one thing we haven't talked about, and it's key. We did touch on it last week, but it's the time. Excuse me. How long does this thing? I said earlier, if you look at it on a 1 year basis, it doesn't look that good. How long does it take to look good, Brandon?
Life insurance?
Yes. No, you.
Well,
still waiting. No, I'm kidding.
I think you're going to be at least closer to 10 years before you start to see something that is showing a remarkable outpacing of the premiums that you paid. You're going to see in most cases, well executed, a positive net gain 5 to 7 years in.
Yeah.
But once you get to year 10, that's when you really start to see those two, like what I paid in premiums and what I have in cash, those start to diverge. Now, at the same time, I would tell you that if you're looking at the numbers and you're evaluating growth year over year, you're going to start to see pretty substantial increases in cash value materializing somewhere in the 3 to 5 year range.
Right.
So you put $1 in and suddenly you have more than $1 accumulating in cash value.
Yes. But you're still going to have a
net loss.
A net loss.
Yes.
Yeah.
Yep.
And we used to say like 7 to 8 years was kind of the magic, but some design features in the policies that were available 13 years ago when we started this are no longer available to the same extent. So the positive internal rate of return on your premium dollar has moved out a little bit.
Mm-hmm. Now, I do want to call a brief timeout to point something out because we spent considerable time talking about kind of the lump sum of movement of cash here. And I don't want to make it seem as though that's the only situation that would warrant looking at life insurance.
Mm-hmm.
Because while we do handle those situations quite frequently, it's not the only thing that we're handling.
No.
And there are a number of people who start out from a relatively young age saying, okay, I am going to allocate some of the dollars I'm saving to something safe to grow over time. And when they talk to us, they're usually talking to us because they want to use life insurance.
Yep.
And I can tell you, having observed those now for the accumulation of those things for just about 2 decades, what that can grow into over time is significant.
Mm-hmm.
And that again, you brought it up. It's going to take some time before it really starts to look impressive. And if you compare it to what's going on with your VOO or your SPY or your decision to buy the, what is it? SOXL is the triple leveraged semiconductor one.
Yeah.
So comparing to those things, it's not going to look so impressive. Of course,
or depressive.
Bad days.
Either way.
Bad days going to look really good. But It's not going to grow like that, but it is going to grow over time.
Yep.
And we've been around long enough now doing this to now have conversations with people who are very much entering that stage of we're going to potentially use the money. And they start looking at the distributions going, oh, wow, that's a far better yield than what I was targeting for these other things that I own that I thought were doing a whole lot better. But it turns out when it comes to what I'll actually be able to do with them, great income, which is what I wanted to do all along, that's life insurance is doing really, really well. And in the spirit of preserving wealth, the more you can generate as a yield and not have to spend down as much because you're trying to sell assets to make money, the better off you're going to be from a I am well capitalized standpoint.
Yep.
So let's address the transfer discussion, because in the spirit of wealth preservation, I think there's a lot of people who hear people like you and I talk about the complexity of taking your money from where it is and sending it to where you want it to go after you die. And they go, yeah, words is complicated, whatever. And even the people who are in line to receive the money go, yeah, words is complicated, whatever. And then they actually experience the process and they go, holy crap, that was a lot of stuff that I didn't enjoy doing.
Right.
And
to a point we've made before, you don't have to be wealthy for it to be complicated.
No. I'm relatively certain I've mentioned this story before on this podcast. There was somebody that I knew back in the very early days whose mother died basically indigent, had a number of health issues, was a Medicaid recipient, but did own a house. And when she died, they discovered how complicated the process was to deal with what few things she had, especially introducing the Medicaid side of it.
Right.
And just the out loud musing that he made to me about it shouldn't be this hard for somebody with no money to die from the finance side. And I'm going to admit I didn't practice near as much restraint as I should have, because there were a number of things related to the subject that I was trying to get him to focus on himself. And I maybe brought them up at that time, which wrong place, wrong time. But this is true. It's complicated, and a lot of people don't plan for it. And your ignorance of the process and lack of planning for it is not going to make the problem go away.
Right.
And it's not going to make people's lives any easier. There are a number of assets that you may hold that people cannot necessarily get access to after you're gone without very specific legal requirements in line.
Right.
And life insurance is definitely one asset that you can name a beneficiary to. You don't have to pay anybody anything to set this up. And when you die, the beneficiary simply contacts the insurance company, provides them with proof that you're dead, and they get paid.
Yep. Easy peasy.
And I assure you, the insurance industry understands the weight of the situation and how significantly important it is for them to efficiently process claims.
Right. Yeah, I had a death claim a couple years ago, and I remember the beneficiary being shocked at how quick everything happened. It was, they let me know. I got the appropriate paperwork together for them, which wasn't a big deal. Very simple. And they gave me the proof. I FedExed everything in, and within a couple weeks, they had actually less than that, I believe, in that case. But I don't want to set an unrealistic expectation.
They got it in 5 days.
It was something like that. That doesn't always happen that way. But,
Right.
But it can, one of the biggest ways I see it helping, beside, the fact that it could be supporting someone or a family or whatever. But beyond that, like in the situation you're talking about, just the process of probating everything costs money.
Mhm.
Everywhere well, mom died and she had a car. Well, no note on the car, but now we got to get the car transferred over.
She was the sole owner of the car, so
Right.
guess what? It's got to go through probate.
Right. And there's, you have to pay fees to have it retitled, and there's, and I'm not saying those are major expenses, but think about everything that someone has. It starts to add up, and like, you may not have access, even if there's money in accounts. It may take you a while to have access to it.
Yeah. Well, I can give you a very, very brief version of a situation that I was personally involved in quite significantly just a couple of years ago when a family member of my in-laws died, and died intestate. So there are many more rules that come into play at this point.
Yep. And also highly depends on what state you live in and all that sort of stuff.
Yes. And a whole lot of being told what they had to do and when they had to do it and how things had to kind of move forward. And house,
half of which was wrong.
Yep.
The first person that tells you, well.
Right. So house, bank account, cars, these are all things that cannot be touched, essentially. I mean that figuratively, in the sense that like they can't do anything with them until the court decides, okay, yes, this is going to that person, that's going to this person. But there's still these assets like the house, and somebody's got to take care of it.
Right.
And somebody's got to pay the insurance bill to protect the property. And
the power bill and water bill and the
Right. All these things have to happen. So the whole process from beginning to end, it took, like a year and a half to finalize, I want to say, which was pretty quick.
And this was not a super wealthy person, right?
Nope.
Just to be clear.
Nope. Very, very normal. But the one thing that did transfer within like a month after death was the cash sitting in an annuity, which operates similarly to life insurance here. So there was a named beneficiary.
Yep.
And that moved to the family members.
Yep.
No problem at all.
Mm-hmm. Just had to wait for the death certificate, basically.
Yep. Within the insurance industry, and I would even say most of the finance industry, there's a lot of discussion about death and transfer that's always brought up in the estate tax context.
Yeah.
And a lot of people, understandably, look at that and say, well, I ain't got those problems.
Right.
And
you're
right.
Probably.
You're right. You don't.
Yeah.
I mean, if you do, because you have that sort of accumulation of wealth, congratulations. Understand that it's due 9 months after you die.
Right.
So, you die, you have 9 months, you got to pay it. And depending on how your assets are set up, you may be in a position where selling in order to have the money to pay the estate tax within that period of time may be quite the task.
Yeah.
So owning life insurance, for example, to create the liquidity to pay for it, I mean, that's a textbook example of using life insurance to deal with death and transfer taxes.
That's one of the first things you and I probably learned about when we got into the industry was.
Mm-hmm. It was that
exact scenario you're talking about.
Actually, I remember exactly how I was introduced to that. Some guy called our office randomly to tell us that he was the trustee for an ILET that held some guardian policies, and he had lost touch with the agent that sold them those policies, so he needed to talk to somebody about them. And I looked at the GA when I found out about this, and I said, "What the hell is an ILET?" And that's.
Did you say eyelid? I have eyelids too, sir. I'm not sure why you're calling us to talk about your eyelid.
So,
yeah.
Now, there can be all kinds of other expenses that have nothing to do with federal estate taxes.
Yes.
That have to be attended to.
There will be. Let's just say will be. Because I've never seen a situation where there weren't.
And this is again where life insurance comes in to create the liquidity to deal with these things. So you can use that cash to, for example, take care of the house maintenance.
Yep.
You can use it to hire the attorney that's going to have to probate the assets that need to be probated.
Yep.
And ensure that you don't have to sell off other things to raise the money to do that.
Mm-hmm.
In
which in many cases you won't even be able to.
Right. So having that money available helps preserve certain things. I've even seen situations where people own, let's say, specific company stock that's meaningful to them.
Mm-hmm.
Usually it's because they worked for the company.
Right.
And they accumulated it through their working efforts.
Right.
And they want to leave those shares behind.
Yep.
This becomes especially true when they pay dividends.
Yes.
Because they want to leave the dividends to whomever and continue to collect them.
Yep. If they worked for the power company.
Yeah.
I mean, that's just a common one.
Yep. If it's sitting in an IRA, that's an easier task. But if it's not, that involves more footwork.
Mm-hmm.
And again, having liquidity through life insurance is one of the ways to ensure that you're not held up in a bunch of expense hell trying to get this $10 a month dividend payment
right
from grandpa.
Yeah. Exactly. It just puts grease on the wheels.
Mm-hmm. It does. And it preserves a number of other assets that may have a very serious mathematical strategy behind keeping them intact.
Yeah.
Sometimes it's just an emotional one.
Right.
I'm not here to pass judgment on either one.
Right.
Don't care. I'm just telling you that you can simplify life for everybody involved when you have liquidity created by the payment of a death claim.
Yeah.
In that way. And life insurance works fantastically well to preserve wealth. And one last thing to note, when you are distributing assets for the sake of retirement or whatever other expenses come up as you age, which could be things like going into a nursing home, having something like life insurance around to replenish the assets that have to be spent is a great way to ensure that your spouse carries on relatively unaffected.
Right.
And I can also speak from personal experience watching some situations where, let's say, dementia came up and one spouse totally fine, the other one dealing with dementia. There's a lot of expenses that go into that situation.
Yeah.
And when you have life insurance that can be paid to then recoup a lot of the expenses that were incurred dealing with the last couple years of life and all of the care that was necessary, it very much brings peace of mind to the table and avoids what could have been a wildly financially disastrous situation.
Right.
So, great wealth preserver. Let me enunciate a little bit better.
I don't have anything else to add.
Okay. Well, we can call it there.
All right.
I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.